If you had to choose between owning a few stocks, or owning the entire market, which one builds more wealth over time? Most beginners believe picking the right stocks leads to higher returns. But history tells a different story. In this video, we're breaking down index funds versus individual stocks, and what actually wins long-term. Section 1. The appeal of stock picking. Buying individual stocks feels powerful. You choose the company. You control the bet. You imagine finding the next big winner. And when a stock rises 20, 30, even 100%, it feels validating. But here's the problem. For every big winner, there are dozens of underperformers. And predicting which company will outperform consistently is extremely difficult. Even professionals struggle to do it long-term. Section 2. What is an index fund? An index fund is designed to track a broad market index. Instead of choosing one company, you buy hundreds or thousands at once. For example, a total market index fund gives you exposure to large, mid, and small companies. You're not betting on one winner. You're owning the system. This dramatically reduces company-specific risk. Section 3. The data behind performance. Historically, most actively managed funds fail to beat their benchmark index over long periods. Why? Fees reduce returns, emotions lead to poor timing, concentration increases risk. Markets tend to reward diversification and patience. Individual stocks can outperform dramatically. But they can also collapse. An index fund smooths the volatility and captures overall market growth. Section 4. Risk comparison. Let's compare risk. With individual stocks, earnings surprises can crush prices. Leadership changes affect performance. Industry shifts can disrupt business models. With index funds, one company failing barely impacts your portfolio. You benefit from winners automatically. Risk is spread across the economy. Risk doesn't disappear, but it becomes manageable. Section 5. Time and skill requirements. Stock picking requires research, monitoring, emotional discipline. Index funds require choosing, allocation, automating contributions. One strategy demands constant effort. The other rewards long-term structure. Section 6. When individual stocks make sense. Individual stocks can make sense if you deeply understand the company. You're comfortable with volatility. It's a small percentage of your portfolio. Many investors use a core and satellite approach. Core equals index funds. Satellite equals small individual stock positions. This balances growth and stability. Section 7. Long-term wealth building. Reality. The biggest driver of wealth is not picking the perfect stock. It is consistency. Time in the market. Compounding. Index funds maximize exposure to compounding while minimizing avoidable mistakes. Stock picking increases potential upside, but also downside. The question isn't which can win. It's which you can stick with for 20+ years. Section 8. Simple example. If you invest consistently into a diversified index fund for decades, you capture economic growth, innovation, corporate expansion without needing to guess the next winner. Meanwhile, concentrated bets increase emotional pressure. And emotional decisions often reduce returns. Conclusion. Index funds and individual stocks are not enemies. They serve different purposes. But for most investors, broad diversification through index funds wins over the long term. Because simplicity scales. And consistency compounds. If you want to build wealth without constant stress, start simple. Subscribe for more structured investing breakdowns. Because investing becomes clearer when you follow a method.